It's the question on every investor's mind, from the professional on a Bloomberg terminal to the beginner checking their phone first thing in the morning. Is the stock market going up or down? And right now, you're probably looking for a simple yes or no answer. But here is the uncomfortable truth that most financial media won't tell you: no one knows for sure. Not the experts on TV, not the hedge fund managers, and certainly not a YouTube video. The market is a complex, living system driven by millions of variables, and trying to predict its short-term moves is a fool's errand. But what you can do is learn to read the vital signs. You can learn to understand the current market environment, gauge its overall trend, and identify the key forces that are pushing and pulling on prices. Instead of seeking a prediction, you need a framework for assessment. In this video, that's exactly what I'm giving you. We're going to break down the 3 key lenses through which you can evaluate the market's health at any given moment. First, we'll look at the technical picture, what the charts and market internals are actually saying. Second, we'll dive into the fundamental drivers, the economic data and corporate earnings that create long-term value. And third, we'll assess the often overlooked but critical factor of market sentiment, the mood and psychology of the crowd. By the end of this, you won't need to ask anyone if the market is going up or down. You'll have the tools to develop a well-reasoned perspective for yourself. Let's start with the most immediate lens, the technical picture. This is about reading the tape and understanding the supply and demand dynamics reflected in the price charts themselves. The first thing any professional looks at is the trend of the major indexes, primarily the S&P 500. The simplest and most powerful tool for this is the 200-day moving average. You can pull up a chart of the SPY, the ETF that tracks the S&P 500, on any platform like TradingView, and at this indicator. The rule is straightforward. If the price is trading above its 200-day moving average and the line itself is sloping upward, the long-term trend is considered healthy and bullish. It doesn't mean it can't pull back, but the momentum is generally positive. If the price is consistently trading below the 200-day moving average and the line is pointing down, the long-term trend is bearish, and rallies are more likely to be short-lived. But don't stop there. You need to look at market breadth. This is a pro tip that separates amateurs from professionals. Breadth asks the question: is this market move being supported by a wide number of stocks, or is it being propped up by just a handful of giant companies? You can check this by looking at the advanced decline line. On a day when the S&P 500 is up, if you see that a majority of stocks are also up, that's a sign of healthy, broad-based buying. But if the index is up only because Apple and Microsoft had a good day, while the majority of other stocks were actually down, that's a warning sign of weak internal strength. It's like a tree that looks healthy on the outside but is rotting from within. Another critical technical gauge is the VIX, often called the market's fear index. The VIX measures the market's expectation of future volatility. When the VIX is low and stable, it indicates complacency and calm, investors aren't worried. When the VIX spikes dramatically higher, it signals fear, panic, and uncertainty, which typically coincides with market sell-offs. A rapidly rising VIX is a red flag that the downward pressure is intensifying. While the technicals show us the what, the fundamentals help us understand the why. These are the economic and corporate realities that ultimately drive stock prices over the long run. The single most important fundamental force in the modern market is the Federal Reserve and its interest rate policy. You need to ask one question: is the Fed in an accommodative or restrictive mode? When the Fed is cutting interest rates or keeping them low, it's like adding fertilizer to the market. Money is cheap, borrowing is easy, and stocks tend to thrive. When the Fed is raising interest rates to fight inflation, it's like applying the brakes. Money becomes more expensive, economic growth can slow, and stock valuations often contract. So, your first stop for fundamentals should be the financial news to see what the Fed is saying and what the current interest rate expectations are. The next key fundamental is corporate earnings. The stock market is a marketplace of businesses, and their collective health is paramount. Are companies in the S&P 500, on average, beating their earnings estimates and showing revenue growth? A market can only climb a wall of worry if corporate profits are strong enough to support higher prices. If you start to see a trend of major companies missing earnings and lowering their future guidance, that is a fundamental crack in the foundation, no matter how good the chart looks. Finally, keep an eye on key economic data points like the monthly jobs report, consumer price index for inflation, and gross domestic product for overall economic growth. A strong jobs report with low unemployment suggests a resilient economy, which is good for corporate profits. But a hot jobs report can also mean the Fed will keep rates higher for longer, which the market might not like. This is the constant push and pull you have to assess. There is no single right answer, but by monitoring these data points, you understand the narrative that is driving the fundamental engine of the market. The final piece of the puzzle is the most psychological, market sentiment. This is all about gauging the mood of the crowd. And ironically, the crowd is often most optimistic at the peak of a market and most pessimistic at the bottom. This is why sentiment is a powerful contrarian indicator. There are great tools for this, like the CNN Fear and Greed Index. It compiles 7 different sources of data, from stock price momentum to put-call ratios, to give a single reading of whether investors are acting out of fear or greed. When the index is in extreme greed territory, it often suggests the market is overbought and due for a pullback. Everyone who wanted to buy has already bought. Conversely, when it hits extreme fear, it can signal that panic selling has exhausted itself and a bounce may be near. Another place to gauge sentiment is in the headlines and on social media. In a raging bull market, you'll see headlines like "Stock market hits new all-time high" and your friends who never talk about investing are suddenly giving you stock tips. This is a sign of euphoria and a potential top. In a brutal bear market, the headlines will be doom and gloom, talking about an inevitable recession and the death of investing. Your social media feeds will be filled with people claiming they're never investing again. This pervasive pessimism is often a sign you're near a bottom. The common mistake is to get swept up in this emotion. The disciplined investor uses it as data. When everyone is greedy, be cautious. When everyone is fearful, it might be time to start looking for opportunities. So, to bring it all together, you don't make a decision based on one lens. You look for a confluence. Is the market above its 200-day moving average with strong breadth? Are the Fed and corporate earnings supportive? And is sentiment cautiously optimistic but not euphoric? That's a very different, and much healthier, picture than a market hitting new highs on terrible breadth, with a hawkish Fed and extreme greed in the headlines. Before we finish, it is my absolute responsibility to provide this disclaimer. I am not a licensed financial advisor, and this video is purely for educational and informational purposes. This is not investment advice or a recommendation for any specific market strategy. The stock market is inherently unpredictable, and all investing involves risk, including the total loss of principal. Past performance is never a guarantee of future results. You should always conduct your own research and consider consulting with a qualified financial professional before making any investment decisions. Your call to action is this: the next time you find yourself anxiously wondering where the market is headed, don't just scroll for headlines. Open your charting app, check the 200-day moving average on the SPY. Then, open a financial news site and read one article about the Fed's latest statement. Finally, pull up the Fear and Greed Index. Go through this 3-step framework yourself. This active analysis will make you a more confident and independent investor. If this framework gave you a clearer way to assess the market's direction, please hit that like button and subscribe for more strategies that cut through the noise. Thank you for watching.